Those who can be on, thank you for joining us. This is meant to be somewhat interactive, so feel free to put your hand up. You could ask a question online in the Q&A box, or just put your hand up and ask the question. It's kind of a high level discussion on high yield energy bonds. We've seen a little bit of interest in this, and it is something in all of our balanced mandates that all of us own in our tactical model. We do own a few high yield energy bonds, so it should be relevant to everybody. I'm going to whip through the deck pretty quickly. It's only 19 slides in total. The first thing is, as a disclaimer, this is informational purposes only. It's not a advertisement or a solicitation in any way to sell you securities or an offering. It's just for discussion purposes. So that takes care of the legal side of the business. By way of background, I've been working in the high yield market since 1998, when I was the head of Canadian credit trading at Merrill Lynch, although I didn't start in that position until 2005, but I started trading high yield and distressed debt back then, so I've got a pretty good background in it. Then I managed the I managed the Advantage Canadian High Yield Bond Fund for Scotiabank. That was about 8 3/4 years. It ended in December 2019. And previous to that, before I started High Rock, I managed a high yield bond fund, a brand new one. And it was a long short hedge fund, a credit hedge fund, for about 1.5 years at NOREP. Scott Tomlinson, who most of you would know, joined me in February 2015. Was it, Scott? Yes, it was. And it focuses a lot on the balanced mandate division that we have. He's got a ton of fixed income. Scott and I first met in 1990 at Merrill Lynch. In fact, I followed his career path at Merrill for about 3 years or so. So he's got a ton of fixed income trading experience. Diane Leckie joined us August 1st. She is a huge addition, doing client service, and she is also now our compliance manager. She has a lot of experience and the chief compliance officer's course under her belt. So what we're going to go through is a quick high yield primer. We'll look at some high yield energy bonds, how they have corrected from the lows, obviously back in March a year ago. We're going to look at some M&A activity in the Canadian energy patch, which is really important, and we'll tell you why, because of the change of control put. I'll explain that. We'll look at some of the yields in the non-energy market and the energy market. You'll see the dichotomy between the two. It's been a vicious cycle in the oil and gas space, especially in Canada, given the political climate over the last 5 or 6 years. But energy companies have now found a religion. They know the regime that they have to work under, and it's going to start creating really strong free cash flow. That's what the FCF is. It's going to lower leverage or debt to cash flow. And I'll give you some strategist thoughts, just a couple quotes. And then we'll look at what I think OPEC is doing, and natural gas demand as we move to a more of a renewable energy space. So very quickly here, a primer on high yield. High yield bonds are typically, by the rating agencies, rated BB+ or lower, so into single Bs and triple Cs, and right down to single Cs, in fact, and then default. The coupons are typically 4 to 10%. They obviously can vary a lot. Typical term is 5 years is very typical in Canada, but it can get out towards 7 and 8 years. So it's very short duration compared to other investment grade corporate bonds. Could be out 10, 15, 30, 60 years in term. So these are very short, which is a good thing in most situations. So you'll see here they rank at the top of the capital structure. Some bonds are in fact senior secured debt, which is similar to bank debt. Most are senior unsecured debt. As you can see, they're still above convertible bonds, preferred shares, and obviously above common shares. So this here is considered the capital stack of a company. The market in Canada is about 12 billion in size. And then in the US, there are about 61 billion through Canadian issuers in the US market. The new issuance is around 2.5 billion a year. This is an institutionally traded market, and the very important thing here is, and some of our clients know, and that's why we have specific high yield mandates, And that's all we do for some clients is high yield, because they can't get it anywhere else. It is an institutionally traded market. High Rock started as an institutional asset management firm. As I said previously, we managed 4 funds at the time for Bank of Nova Scotia. So it trades typically in 1 million board lots. 5 million positions in most positions, most names are easily tradable. A little bit more on the primer here is there, as I just showed in that capital stack, they are structurally senior. They do produce strong risk-adjusted returns, which I do not have in this deck, but I could show anybody offline if they want. Same with low correlation to other asset classes and zero correlation interest rates. I do keep track of all that, but it's not really part of the energy space that we're going to talk about today. I mentioned some of our experience, as you can read here, which gives us some credibility in this space. So high yield energy bonds. I'm going to use one bond here, Crew Energy. It's a bond we actually own in our tactical model, in our balance mandates. This is back in March 2020. They were sitting around 30 to 40 cents on the dollar. As you can see, a big drop off. And they've ground their way back, and we've had a couple big moves up recently, like one in December and then one again kind of in January. That bond now is sitting around $91, just above 90, as you can see here. So bonds have moved up, no question, as every asset class has. So I'm not going to say they're cheap. Sure, they were cheaper back here, but we'll get into why I think there's still good value in them. Number one here is the mergers and acquisitions that have gone on the past 6 months or so. And this is really important. Previous to these mergers that have all gone through the last 6 months, what we saw was a company, one energy company would buy another, and both their stocks would decline on the announcement. So they just stopped doing them. Like 2, 3, 4 years ago, they just like stopped doing them. But now they're getting a positive response. Both stocks are going up, and you can see some of these are big mergers. In fact, that one actually, Paramount they bought just about 2 months ago, about 20% of NuVista. So some of them are not full mergers, but sort of acquisitions of property, as you can see here as well. Crescent Point bought Shell's assets or some of their assets. So the point here is, I think this is going to continue. They're getting a positive response from the market. It's going to feed more consolidation. And why is that so important? Because every one of these high yield bonds has what's called a change of control put, unlike an investment grade bond. So the reason why is that if a company is acquired by a lesser credit, that bond would go down in value. What we're seeing now or what we do see with a change of control put, you've got an option. The holder of that bond has an option to sell those bonds back to the issuer or the acquiring company at a change of control at 101. Almost every bond has a change of control at 101. So if your bond's trading at 90 cents on the dollar, and just say you're getting 8% coupon, and it's trading at 90 cents on the dollar, you're going to pick up 11 points of capital gains. So for a total return of whatever your carry is, plus wherever your bond is trading, plus 101. So it can be very impactful for these high yield bonds. So where are the bonds trading now? Well, I said the market was somewhat bifurcated. You've got non-energy bonds trading anywhere from a low at 2%, like Quebecor, which obviously Montreal or Quebec, the telecommunications cable operator, cell phone, all through Videotron, which is their opco, their sub company. And you know, these bonds are priced to perfection, if you ask me. And then you've got some non-energy bonds that are trading higher. Empire Communities is like a smaller version of Mattamy Homes, family-run business. We bought this bond back, I believe it was January. It might have actually been in December, but it's a really good bond. I quite like it. And it traded up right away from par to 103, 104 area. And you can see its yield is 640. It's pretty decent, but it is a private company. It's not a big, large public telecommunications company. So most of the bonds are trading in that 2 to 4% yield to call, which means the issuer can call the bonds at a certain price and then reissue new bonds at a slightly higher coupon. So a bond might be trading at 2% yield to call, and the issuer could call it and issue a new, maybe that was an old 5% coupon. They might issue the next bond they issue for 5 years might be 2%. 4% coupon. So a slight reduction in their interest expense. Now, energy bonds, the lowest one is trading at 1.5, which is almost irrelevant because it's 7 Gen, which is being acquired. So it's trading to its takeout price, effectively near 101. The high, there's a distressed bond, Source Energy, which provides sand that goes down the pipe and helps for fracking, oil and gas fracking, effectively. It's trading around 45% yield to maturity. Most of the energy bonds right now, after the move we've had over the past year, are trading at 8 to 10% yield to maturity range. So it's still pretty stout, in my opinion. And given the acquisitions we're seeing, it could be very impactful, and we'll see at the end. Now, the cycle that we used to see, the old cycle pre-2016, I follow a lot of these companies. I talk to some of the CFOs on my conference calls. Every quarter they report, I update my models. So I do follow what they're doing. And what they used to do was, oil prices would increase. Capital would enter, they might issue stock, they might issue more debt, they draw down credit facilities, they increase production, they increase OpEx, they weren't terribly disciplined about it. Then all of a sudden oil gets oversupplied, oil price declines, and then they go through cutting, and they cut everywhere they absolutely can, and then capital flees. Now, what's different this time is this new cycle. These E&Ps, which are exploration and production companies, the oil and gas, they're not actually increasing production like they used to, and they're keeping a lid on operating expenditures, and capital has already fled to a fairly large degree. And a lot of it went over the past year into renewables. We could actually talk about that perhaps later, but I do have it as a risk for sure. But this is the new paradigm. So the old model was increasing production, increasing debt to fund production. It was like production had to grow all the time because they had to continue to pay a dividend, and they were very reluctant to cut these dividends in bad times. It was very undisciplined. And now what we're seeing is they cut OpEx, operating expenditures, and they fight any cost increases from the oil field surface operators, the drillers, the ones who provide sand for fracking, you name it. They're really fighting these OpEx, and I'll give you an example later. They are all self-funding their capital expenditures to explore and drill right from operating cash flow. So they're staying inside their operating cash flow, and if it means they're producing 70,000 barrels per day, that's what they're going to produce. They're definitely showing capital expenditure discipline. They're holding production in line with that to get some synergies, but they're not blowing their brains out. They are hedging using the forward strip, which means, oil could be every month there's a different contract for oil. And a lot of these guys, most every one of them, hedge out their production for a year plus. And not all of it. They might hedge out depending on their policy and what the bank credit facility requires them to do. I would say on average, they hedge out around a third on a 1 year forward basis. And consolidation it really helps remove some of that office costs. So if one acquires another, hopefully their lands are close. That's why part of the reason why they would be acquiring them. But there's not enormous synergies in acquisitions in this space, but certainly head office costs, registration costs with the stock exchanges, auditing costs, obviously some human resource costs, et cetera, can be stripped out. There's no thoughts of paying a dividend, and I say yet, but when debt reduction is number one, then some of these guys are going to become debt-free and dividend-paying companies, and that's going to be very interesting. Now, I would say that's 3 to 4 years away. So a couple quotes here, and this is a National Bank chart. Actually, it just came out late last week. This represents an average reduction in debt to cash flow, D to CF, debt to cash flow. So you can just see, I highlight Baytex because it is a company that we own in some mandates and one we use as a case study at the end. I'll show you in a second. But you can see the debt to cash flow is darn close to 6 times leverage in 2020. And using the forward strip on oil and gas, mostly oil for this company, they're going to drop it in half. They're going to be down to like 2.5 times leverage. So it's very impressive. And you can see this through various companies as we go across the bottom. So the dark blue is 2020, the light blue is 2021. But you can see how they're all stripping out a ton of leverage just by virtue of the fact that oil mostly, but gas to a certain degree, has increased in value. So that is a National Bank quote, as you can see, and that's really what he's saying. Rosenberg was saying, more particular to energy stocks, are trading at a historic 20% discount. And Michael Tran is a commodity analyst at RBC, get his research. He maintains a view that WTI prices will average 57 this quarter and 66 in the back 3 quarters of the year. So there are some folks who are somewhat more bullish, and we're seeing that in pricing. OPEC, I think OPEC is really trying to stabilize the market here. You know, as the Russian foreign minister said, the current price level more or less reflects this balance. And that was from their 2 weeks ago from their statement. I think they meet again in late April. We'll see if they continue to be bullish for the price of oil, but we sure could use stability. We don't need to see that again, where I can't remember what that number is, but if you recall back last April or May, oil traded down to minus $40 a barrel or something. So if you have a swimming pool that wasn't filled with water yet, you could have actually done pretty well taking delivery. Now we'll move on to natural gas just for one chart. And this is kind of interesting. So we talk a bit about renewables, but natural gas really is a clean burning fuel that is going to be a bridge to getting renewables up and running. And this is going to take a long time. I read an article last summer, it might have been in The Economist magazine, that the average change in fuel source, energy source rather, takes about 150 years. And I think we'll be a lot faster than that, but we've been working on renewables for quite a few decades as it is already. They're not going to happen overnight. And don't forget that a lot of these other forms of energy are not just energy. They go into different manufacturing processes. Gas, not so much. But you can see the growth in gas is significantly more than any other fuel source or energy source. So I am quite bullish on gas, and part of that is LNG Canada. In Kitimat, BC, in 2023, I think they're going, one of the owners, the equity partners, is going to be short gas, and they'll need to do some acquisitions for feedstock. Now, so having said all this, there are risks to this idea. Any portfolio of high yield bonds carries substantial risk for sure, and there, you know, there's credit risk, there's risk of default, etc. OPEC Plus could fall apart at any time. It's been a volatile entity, and obviously that creates volatility in the underlying commodity. And natural gas is much more related to weather on this continent than oil is much more of an international commodity. They are all priced in US dollars. So when the US dollar strengthens, as we've seen over the past week or so, prices of these commodities can decline rapidly. Investment capital to fossil fuels has already declined, and it's been declining, I would say, for 3 to 4 years. But it really accentuated last year in 2020. There were people that just would not want to invest in fossil fuel investments in any way. I think that's short-sighted in nature. Fossil fuels are going to be here for a long time, according to that previous chart. There's also pipeline bottlenecks that happen. Refineries as well, they get bottlenecks. They could be heavily regulated. but that could be problematic too. So those are just some of the risks that could occur. So I'm going to run through a quick, just 3 more slides, case study here on Baytex Energy, which is one we mentioned before. I won't go through all the detail, but this has, as you can see, banked at about 650 million. Sounds like a lot. Some are a lot more. It's a very unique credit facility, the borrowing base. It's not, most energy companies, this is the only one I know that doesn't have what's called a borrowing base, which means these energy companies constantly need to drill to create reserves that create a borrowing base so they can go to their bank and say, okay, we need to borrow X. The bank will look at it every 6 months and determine what their borrowing base could be. And that's how they lend them money. This one, Baytex, is not. It's actually effectively a revolving loan. And it doesn't have these annual resets. It's much more stable. Then they have a couple bonds outstanding, about 1.2 billion almost, and then they have market cap of roughly 800 million. So I won't go through all of these credit metrics and all these numbers, but I'll maybe just highlight the leverage, as I said before. Leverage is the amount of debt they have to cash flow. As of the 4th quarter, they were running around 4.4 times. And I think that's going to be at the end of 2021 around 2.6 times if oil stays around $60 a barrel this year. Interest coverage is the amount of cash flow they have that pays the coupon interest on our bonds and the credit facility. Right now it's at 4 times. So they've got 4 times the amount of cash flow as they do interest expense. But if oil stays at $60 a barrel for the year, that goes up to 5.6 times. It's a very good thing for the bonds. And this is important too, break even, the operating cash flow funds the capital expenditures all the way down to $35 a barrel. So that's pretty good. So even though COVID-19 hit and it was like a double whammy for all these energy players, these guys still produced free cash flow on 2020 of only 28 million, but it's quite stunning. And a lot of that is come through cutting operating expenditures. So they have a couple bonds. This one, 2027, it's a US dollar bond. It's a bond we actually own. And let me just go through here. So what we're going to do is look at, this is kind of a grab from Bloomberg, but I want to give you an idea for what you could or make or lose. This is really more on the upside, but if you bought a bond, this bond today at 92 cents in the dollar, and 100 cents in the dollar is considered par, it would have a cash yield of roughly 9.51 and yield to maturity at 10.5. Okay, so as you can see, it's right here. And I did this on March 18th, but if you bought it at 92, you waited 1 year till March 18, 2022, and it stayed at 92, didn't move, ceteris paribus, you would pick up, whoops, my bad, you would pick up 9.11 in a holding period return. So you're effectively the amount of interest income that you would earn on that bond in a year. If the price did not move from 92 to 92, you make 9.11. Now, which is not bad. Now, if scenario 2, if that bond you buy at 92, you hold it for 2 years, and if I'm right, and there's more M&A going on, and that company, Baytex, is taken out by some competitor, presumably larger, we would exercise a change of control at 101. So we buy the bond in March 2021 at 92. March 2023, the bond's taken out at 101 because of this change of control on some acquisition. We would make 27.5% basically in total in the carry, plus the change of control going from 92 to 101. So that can be quite impactful. And that is the end of the slide deck. So I'm going to leave it there and open it up for questions.
Paul, I'm just gonna jump in for a second to remind everybody that they've all got different levels of understanding of some of this information, and that so there's no bad questions. So please, feel free to ask any question. Don't feel intimidated, because it's a lot of information, and we want to make sure that everybody who's listening has some clarity. Right?
Yeah, for sure. No bad questions. It is high level, and I some of the jargon I used may be difficult, and you may not know what it was. So no bad questions. There may be bad answers, but no bad questions. So go ahead, anybody. Scott, do you have a question?
You talked a little bit about something called carry in the last slide.
Yeah.
Just maybe explain what carry is all about.
We'll use this slide maybe. This one's probably a better way of showing it. So we're getting an 8 3/4 coupon on this bond, 8.75, but we're buying it at $92, so it's a little bit lower than par, which actually works out to a yield of roughly 10.57. But that's kind of a misnomer. But so we're buying it at our dollar value. The dollar amount we're putting to work is less than par. So we're getting a little bit of a leg up from 8 3/4. If we bought that bond at par and it stayed at par for 1 year, we would make 8 3/4. But because it's below par, we're actually making 9.11. So carry, when I say carry, it's really the interest income that you are earning from the bond you own. Bonds pay coupon interest every 6 months, but the interest accrues every day. Every day we own the bond. So we could own it for a week and sell it. The buyer pays us. The buyer who bought the bond from us pays us our interest back. So every day we own a bond, we get paid. So that's called, when I say carry, it's really the interest income we are getting from that bond for the period we hold it for. And that's the HPR, is the holding period return. So if you bought it at 90 and a year from now you sold it at 92, we would be making even more, because we'd get 2 points of capital gains and our carry, or our interest income, for that 1 year period, which we know is roughly 9%. So our holding period return might be more like, well, we're picking up 2 points. That's a little over 2%. So our holding period return would probably be 11.15 or something for that period if we bought at 90 and sold at 92. Yeah, if you bought it, conversely, if we bought at 92 and we sold at 90, we would lose about 2% or so. So we would yield, 7%. Our holding period return would be about 7%. If we bought at 92, you got to figure, what's our break even? That's an interesting question, Scott. So if we bought at 92, what could the bond go down to before we started losing money? So we know we're getting roughly 9% to carry it for a year. So if bought at 92, we'd probably be down around 83, roughly 10 points. Well, 8 or 9 points actually. So probably 84 to 83. Then anything lower than that, we'd start losing money, because our prices drop substantially from 92 to 83, say. And if it starts going to 80 and 75, etc., then we got a problem. But the other way to look at this is, well, from 92 to 80, let's even say 84, that's my break even, 84. So call it 8 points. I've got 8 points of downside. Sure, we could have another situation like last March or March, April, where you just get annihilated. But that was probably more of an exception than the norm. So you think, well, if I buy this thing at 92, I've got some cushion. I'm going to have some mark to market, and the price could go up and down, but I've got cushion. And that's the beauty of having a high yielding bond in your portfolio compared to, say, a non-dividend paying stock. And when some people look at dividend paying stocks, they're talking about, 2-3%. Well, in some stocks, you could lose that in a day. It's more unlikely you're going to lose 9% in a day. It's going to be the exception, not the norm.
What about the fact that, what if you hold it to maturity? I mean, prices will fluctuate. They'll go up, they'll go down. As we've seen through most of the downside of 2020, a lot of prices did rebound, and bondholders who stayed in those bonds collecting the coupon interest, if they take it to maturity, then there's some capital appreciation built into that
For
too,
sure.
right?
Yeah, absolutely. And I could have done, a dozen of these sort of holding period returns as examples, but yeah, I mean, you could buy a bond, as we did this bond, quite frankly, went from par all the way down to 30 cents on the dollar last year to right back up where you see it now around 92. In that period, we had some pain, unrealized mark-to-market pain or losses, but in the meantime, we collected 9%, and I think actually this company will be taken out in about 2 years' time. So I think we'll happily collect our coupon through this interest income, and hopefully get a nice big change of control put to boot in a couple of years' time. So that's the benefit to high yield, is you're picking up a high yield. Now, it's not without risk. It has, as you said, Scott, a lot of ups and downs and mark-to-market risk in between. But if you don't sell it and you still like the credit, the company, then you have a lot of cushion to be able to absorb those mark-to-market fluctuations.
Talk a little bit about that change of control put again, just the whole put idea and what that actually means.
Here we go. So a put is really, people have probably heard of options, and they have call options, which give the owner of that option the option to buy at a certain price. And a put gives the owner of that put option the option to sell at a price. So in this case, if we own a bond, I'll give you another example. So if we own this bond, let's just say this Baytex bond, and say it was bought by Suncor. Well, Suncor is the largest Canadian energy, well, maybe CNQ is, but it's a large investment grade rated energy company. And they issue debt at, well, say 3%. So they could issue their own debt at 3% and buy all of Baytex stock and bonds, and they'd be done. But we own this bond, and it's our option to sell it to Suncor at 101. It's our put option, not our requirement. So we could say, well, no, we don't want to sell it to Suncor at 101. We want to actually hang on to it, because Suncor bonds trade at 3%, not 8.75% or 8.5%. So the real upside, if it's an investment grade acquiring company, comes from, I don't know where that bond would trade, Scott, like an 8.75 coupon, where it would trade, but it might be up at like 115, 120, 125. Like that would be a grand slam. But that could happen. And it's rare, but it could happen for sure. So the change control is a put option that the holders have to sell their bonds at 101. Sounds great when they're trading at 92. You want to sell them at 101, be done, great. But if it's an investment grade issuer buying them, you would never exercise that option. You would hold out. And they may come in and negotiate with you and say, we'll buy them at 110 or 115 as opposed to 125 or something. So, but they would effectively, in this situation, this example I'm giving, Suncor would be responsible for buying those bonds back or guaranteeing them, and they'd be Suncor risk. So that's where Suncor trades. That's where the bonds are going to move to. That's a good question. Anybody else have any questions? All right. Scott, do you have any more?
No, I think you've answered all mine, so that's great.
Oh, hang on, there's one more here I've got. Do you think that any of the reduction in operating costs due to COVID-related government stimulus? No. So the question is, do you think any of the reduction in operating costs or OpEx, say for Baytex, for example, are due to COVID-related government stimulus? No, I don't think so. Like, there are quite a few companies that I look at outside of the energy space as well that did take government, like the CEWS, the wage subsidy. And quite frankly, I think the way to look at it is, if they didn't take that wage subsidy, they would have hacked away at labor, unfortunately, and laid off a lot of people. No, I think these, I would go back wherever I have that slide. This new paradigm here, this new cycle, these operating expenses are gone, and they will go up a SNCC for sure if energy prices remain elevated and they need to increase production of SNCC. But I'm telling you, most of the companies I follow are not increasing production beyond cash flow anyway. And unless you're a heavy oil producer, heavy oil they can't increase and decrease production like light oil and natural gas. Light oil and natural gas can increase production like in a heartbeat. These guys cannot. So these are more, I would say, largely more permanent and on the the fixed cost basis, as opposed to the variable cost basis. So I think they're showing a lot of discipline. It's not government subsidy related. That's a good question too. Anybody else have any questions? Okay, well, let's end it. We've been a while. I want to thank you all for joining and listening. And one sec. If you have any questions, any further questions, please feel free to contact me or Scott, and we'll do our best to answer them. So thank you again.